Oh, okay, we're going to begin everyone right now. I'm Russ McKeon. I'm the program coordinator for the Transitions in Retirement program. This class is open to the public, so you don't have to be an OLLI member to attend it. We do require now, since we're on Zoom, that you register on our website to get an open to the public class Zoom ID so you could come to these classes. This spring, we're starting our 14th year in Tier Essentials. This was the original open to the public class, the first one. For this class, we need a lot of volunteers to help put it on each week. And so we have several people who helped acting as Zoom host and co-host each week. So we do kind of a rotation of many of us. Today, Bill Riley and I will be doing the hosting for today's class. In terms of the program here, the tier class is part of this class, Tier Essentials, is part of a series of transition to retirement classes. We have a second class that's open to members. You have to be a member. It's called Personal Finance. It's on Tuesdays from 3:45 to 5. That class has a certified financial planner that covers a wide variety of topics. Another thing that I do for this class, I send out a weekly email that will give you the next two classes. I also, if a presenter gives me a handout for the meeting, I'll post it there. And we also post that on the OLLI website next to the class name. Okay, let me introduce James here. And James has been coming and doing this presentation since 2013. So this is his 9th year doing this. And he's one of the reasons that we've been able to keep this class going so long. We have a number of presenters who come regularly, and the kind of material that he shares changes from year to year. So we're very indebted to people like James who come and present to us. James is a licensed, what they call enrolled agents. He's been doing taxes for 12 years, and he's currently the owner of the Tax Guy in Fullerton. And I'll let him take it from here.
Hi, everybody. So yeah, like Russ said, with this presentation in years past, it's usually hands pop up all throughout the presentation and we answer questions as we go. But because we're on Zoom this year, when that question pops up in your head, throw it in the chat, and then I'll go through all the different questions that are showing up in the chat every 15 minutes or so. So what we're going to cover today, this is what tax situations you will face in retirement. So this is not really going to be going over how to, save up for retirement and, how do you get tax breaks in doing so. This is really covering what happens once you are retired. Okay, so let's see here. Is it, there we go. So like Russ mentioned, my name is James Johnson. I'm an enrolled agent. For those of you that don't know what an enrolled agent is, it is very similar to a CPA license, but instead of being licensed with the state, I am licensed directly with the IRS. I have an office in Fullerton. I've been doing taxes for 12 years, and this is my 9th year here presenting. So what are we going to cover today? We're going to cover some of the new tax law changes, not all of them, and we're just going to touch on them. I'm not going to go into too much depth in some of them. We're going to cover Social Security and how it affects your taxes, because for a lot of people, that's a big surprise once you retire. We're going to talk about the difference between traditional and Roth IRAs, as well as selling assets such as your home or stocks and how that affects your taxes. So some new things to watch out for. Some of these things are from the CARES Act, which changed taxes in 2020, as well as some of these things are from the Tax Cuts and Jobs Act from 2018. So you're going to see an increased standard deduction, but no exemptions. So it used to be your deductions were split between deductions and exemptions. They just kind of combine that all, and then now you just get an increased standard deduction. Now, what that means is some people may not need to file because of the increased standard deduction. And for many people, what we're finding is you are no longer able to itemize your deductions. For example, a married couple, it's $24,800 standard deduction this year, whereas before it was half of that. And so if you had $15,000 in itemized deductions, you were able to itemize. Now you would not be able to because you fall below the standard deduction limit. And so we're seeing a lot of people not able to itemize anymore, and that affecting taxes. We're going to cover how distributions are being taxed this year, especially from IRAs and 401ks, which we'll get into a little bit later. We're going to touch on RMDs, required minimum distributions, and how they can be taken later and how they were affected for 2020, and how does Prop 19 affect you. I'm not going to go into all the details of Prop 19, but really just how it affects your personal property taxes, and how that could affect your itemized deductions. So there's no more healthcare mandate at the federal level. But where there is a state one. So many of you, I know that will be, Medicare eligible and won't require that, but keep in mind, should you have any dependents that you claim, especially with everything that's going on, we're seeing a lot more people move back home with mom and dad, not able to work in 2020. And so mom and dad might be able to claim that dependent, but then you are on the hook for any penalties if they did not have health insurance at the state level. There is a limit on mortgage interest, as well as a limit on SALT taxes. What are SALT taxes? State and local income tax. So what that has to do is state taxes you paid, state taxes you had withheld on W-2s, state taxes you had withheld on your 1099-Rs, so your pensions, your 401ks, your IRAs, as well as your property taxes. All that's lumped together and is now limited to $10,000. That happened in 2018, so you've probably, if you were affected by it, you've already seen the effects of that, but still good to know. No more deductions for casualty or theft loss. So if you have a big, have a break-in and you lose money, or have a car accident and insurance doesn't cover your car, you used to be able to deduct that. That is now gone as well. And a big thing that I've seen for my clients that are retirees are investment costs are no longer deductible. What are investment costs? The large ones we would see for managed accounts. So you have a managed account with Schwab, JP Morgan, or whoever it may be, and you are paying, typically, 1% of the value of the portfolio. You used to be able to take that as a deduction. That is no longer a deduction. So keep that in mind when deciding whether or not you're going to have a managed account or not. So this is probably the biggest thing that causes people to run into trouble in retirement. Is Social Security taxable? And the big question, or the big answer, is maybe. It depends. And unfortunately, that's going to change for each individual situation. Okay. Now, how much is taxable? Once again, it depends. So what you need to understand is Social Security is taxable, and it can be taxable. Up to 85% of it can get taxed. That does not mean that your Social Security is going to get taxed at 85%. It means that if you have a $10,000 Social Security payout throughout the year, up to $8,500 of it can be taxed as normal income. How it gets taxed and what the rate is will all depend on the rest of your income, because it'll just be added on as ordinary income to the rest of your income, like your other distributions, interest, W-2 income, whatever else may be out there, and it will just be taxed at the tax rate that you fall at. So an example of this, Bob Jones has the following income: one W-2 for $10,000 in wage, or one W-2 for $10,000 in wages, one 1099-R for $5,000. That can be for any type of retirement income, as well as Social Security for $15,000. In this case, Bob's Social Security is not taxable, but because in 11,725 of his Social Security income in this case gets taxed. So all we in this situation, the only change is the wages wages went up a little bit, but the wages did not go up a little bit, but the 1099-R was increased by $20,000. So he took out an extra $20,000 out of his retirement account, but he's not getting taxed on only that $20,000. He's getting taxed on $11,000 extra of his Social Security. So when he planned for his taxes, he said, and these many times when I see this, he'll have a few extra dollars taken out to cover that $25,000. Hey, I had them take out extra taxes so I wouldn't have to owe at the end of the year because I knew I took an extra $20,000 out, but he wasn't planning on getting taxed on an extra $31,000 in income. And then in the end ends up owing. And then when you owe, you're going to typically owe penalties on top of that for not having enough withheld. So a little, a bit about, taking Social Security and how much you can get. So traditionally, the full benefit age was 65, and early retirement benefits were first available at age 62 at 80% of full. Currently, they've upped the full retirement age to 66, and will eventually rise to 67. So what does that mean is the early retirement age is still 62, but if you take it at early retirement, you are going to receive a little bit less than the 80%. It's going to be and then it increases every year you wait up until you reach the full amount of either 66 or 67, depending on when you take it. And if you wait past 67, you'll be able to see an increase in the amount that you're going to get. So you'll be able to get more than 100%, all the way up to 70 years of age. So an example, an individual reaching the full benefit age in 2020, 66 years, receives an additional 8% benefit for each year he or she delays collecting benefits. If he or she delays taking the benefits until age 70, the benefit will be 32% higher because of that delay. The maximum retirement benefit for someone who waits until age 70 to collect benefits right now is $37.70, but that changes every year. That was what it was in 2019. As opposed to the regular amount, which maximum amount, which is $2,861. Now, keep in mind, the more Social Security that you're getting, the potentially more that is taxable. So take that into account when deciding whether or not you are going to receive benefits early, on time, or delay them. 75% of people will claim Social Security benefits before they reach full retirement age. And with that, if people do have Social Security that is taxable, you have different ways of planning for the tax bill at the end of the year. You can have extra taxes taken out of other distributions that you receive. You can send in estimated payments, or you can even fill a W-4V, which allows specific percentage rates to be taken out of your Social Security. Those rates are 7, 10, 15, or 25. There is no, additional amount. There is no, in-betweens or anything. It's those amounts. So that's a way that you can, but you don't have to have it taken out of the Social Security. That's just an option. Like I said, you can have it taken out of the Social Security. You can have it taken out of other distributions, or you can have it just paid as estimated payments, whether you're sending in checks or having automatic deductions from your account. This is actually a good breaking point. So I'm going to touch on a couple of questions that have popped up in the chat. Investment costs are no longer federal. Is that true for state? Actually, the state is still allowing the investment costs to be deducted. Most of the stuff that the feds got rid of, the state of California does still allow. Now that's going to depend state to state. What if your income during the years that you delay receiving Social Security benefit is much lower than it had been in? Well, keep in mind, the increase is a percentage increase. The amount of Social Security you're getting is based off of your total wages. So I wouldn't be able to help you with how much you're going to get. You'd want to talk to a Social Security specialist on that. But the amount that it increases, it goes up 8% no matter what. It's just the amount that you qualify for will be affected by the amount of money you're making. So next we are going to cover IRAs, individual retirement accounts. So many people don't understand with the IRAs, keep in mind that that first word, individual. So it is not a joint account. It is not something that you can contribute to for yourself and your spouse. It is for you and you alone. Now you can have one and your spouse can have one, but they are individual accounts. So when we talk about limits to deposit, limits to contributions and whatnot, it has to do with each individual account. So an IRA is a personal savings plan that has tax advantages for setting aside money for retirement. Contributions to a traditional IRA may be fully or partially deductible based on AGI limitations. Now keep in mind when we talk about these deductions, we're talking about traditional IRAs. There are Roth IRAs that have completely different rules, and which we will cover in a little bit. So IRA contributions must be made by the due date of the return, usually April 15th. This is very important. So right now, if you are eligible to make an IRA contribution for 2020, but didn't, and you come in and let's just say you were coming into my office and you owed taxes at the end of the year, and you want to talk about how can we reduce this, you would still be able to, up to April 15th, go make a contribution to your IRA account and take that deduction on your 2020 tax return. All right. The IRS allows this, so you can lower your tax liability after you've already kind of figured out what you actually end up owing, because you may not want to make a contribution this year and you may not need to because you don't owe any money. But it may be a year where, something happened and you owe a little bit extra money, but you'd rather keep that money. So you make a contribution to your IRA. Keep in mind, contributions to an IRA are not a dollar for dollar deduction, or, you put in $5,000 into your IRA, you're not going to see a $5,000 savings on your tax return. You put in $5,000, you may see a $500 to $1,000 savings. It really depends on what your tax liability is, as well as what your tax rate is. So a taxpayer or taxpayer and spouse, if on a joint return, must have earned income in order to contribute. So that is very key. In order to still be able to contribute to your IRA, you must have earned income. Earned income comes from two sources. Two sources are a W-2 or a business. And the business cannot be like rental property or something like that. It has to be an actual business. So you must file a Schedule C or have W-2 income. If you don't have that, then you are not able to make a IRA contribution, no matter how much money you're showing on your tax return. There are two types of IRAs, traditional and Roth. So we're going to go into a little more depth of traditional IRAs. A traditional IRA is an IRA where the deductible contributions and earnings on those contributions are not taxed until they are distributed. So this is called a tax deferred account. So what happens? I put in $5,000 into an IRA and I let it sit there for 20 years. And in that 20 years, I've retired and now it's worth $20,000. And I want to take that $20,000 out. I'm going to pay taxes on all of that $20,000. Because for the $5,000 that I put in there, I took a deduction on my tax return on the year I contributed it. So therefore it made it essentially non-taxable when I put it in. And so when I pull that money out, I'm going to pay taxes on that. Now, how much in taxes do you pay? Once again, it depends on the rest of your income, because it'll just be added as ordinary income. And it could be anywhere from, 10 to 37%, depending on how much other income you have. There are non-deductible contributions that are not taxable, but the earnings are taxable when they're distributed. So for the example of this, if you put in $5,000 in your IRA, but you were not able to take the deduction because let's just say you made too much money that year, or something else, you can still put that money in there, but you don't get the deduction. And then that same $5,000 turned into $20,000 in 20 years, and you pull that full $20,000 out. Well, the first $5,000 already got taxed. And there is a form that you need to have filed when in that year that you made the contribution, letting the IRS know that you have $5,000 in this IRA account that's already been taxed. And so when you pull that money out, it still shows a $20,000 distribution. Well, you got to tell the IRS, no, I already paid taxes on that first $5,000. I only have to pay taxes on the other 15. A traditional IRA can be established at many different financial institutions, such as banks, credit unions, insurance companies, and brokerage firms. Lots of different places. Most likely you can just walk into your bank and they'll have IRA accounts that you'll be able to contribute to. Deductibility of contributions may vary, but they are based on your circumstances and AGI limitations. What circumstances? The AGI limitations change based off of your filing status. The amount of income you can make and still contribute to an IRA is going to depend if you're single or married filing joint or married filing separate. So can traditional IRAs be taken out tax-free? Well, it depends. It depends on all your other income. Let's just say it's in a year that you have no other income. And like I mentioned earlier, you get about a $24,000 standard deduction. So we're just going to assume in this situation, no one is itemizing. And I'm using the round $24,000 for, easy math here. You'd be able to take out $24,000 out of your IRA. And since that's your only income, you're not paying any taxes on it. So essentially you get to take that money out tax-free. Now, once again, it's going to depend on the situation. I'm not saying you're going to always be able to take out IRAs tax-free or that you may ever be able to do so. It'll just depend on your situation and how much other income you have in that given year. So Roth IRAs. So we're done with traditional IRAs. So a Roth IRA is also an IRA, but operates very differently than a traditional IRA. For example, contributions to a Roth are never deductible. So you don't get to deduct any of that money that you put into a Roth like you do a traditional IRA. But the idea of the tax benefits of a Roth IRA is that when you pull that money out, you don't pay taxes on any of it. So for example, I'm going to go back to use the same example I talked about earlier, putting in $5,000 into a Roth. Well, you paid taxes on that $5,000. Now, in 20 years, once you've met all the criteria, which I'll go over in a little bit, you take out that $20,000. Unlike the traditional IRA where you would pay taxes on the full amount, or the $15,000 if you pay taxes on that $5,000 when you contribute it, you would pay taxes on none of it because it is a qualified Roth distribution. So that is the benefit, is you don't get the tax deduction right now, but you get the tax break later on, and that you won't pay any taxes on a qualified distribution. So what is a qualified distribution? Qualified distributions, you must be 59 and a half, and that money must have been there for 5 years. Okay. So once you contribute that money earns has to have been there for 5 years. Once it has been there for 5 years, you can take the money out. So for example, you're 58 years old and you contribute to a Roth IRA, and by the time you're 60, that money is doubled. If you were to pull that money out, you're going to pay taxes on the money that your money earned because it has not been there for 5 years. That 5 year, so it's not only do you have to reach retirement age, the money has to sit there for the 5 years. Now keep in mind the money that you put in there that's already been taxed can always be taken out without penalties or without having to pay taxes on it. It's just the money that the money has earned has to still be in there, or else you're going to pay taxes and potentially penalties if you're not 59 and a half. I have one question real quick that I'll answer. Any rumblings, the due date 4/15 may be delayed this year due to COVID? Right now, there is not. The only delay that has happened is the opening of tax season. So the IRS just announced that they will not be accepting any tax returns until February 12th this year. Usually it's mid to late January, but because of the stimulus and everything that's coming out, that is still coming out, they have delayed the filing dates. All right, so rolling over money to different types of retirement plans. So a rollover occurs when assets are withdrawn from one eligible retirement plan and all or part is placed in another eligible retirement plan. This must be done within 60 days. This could happen when a taxpayer leaves one job and takes another, or you're deciding to cut ties with a bank or a brokerage account or something. The rollover amount is not taxable, but is reportable on federal tax return. Partial rollovers may have a taxable portion. So some distributions that cannot be rolled over, a required minimum distribution. So if you're taking an RMD, and actually that should be changed to 72 now, I just noticed that, cannot be rolled over into another account. These are tax deferred accounts. They want you to eventually pay taxes on it. Okay. Or a hardship distribution. Any taxable amount that is not rolled over must be included as income in the year received. Now, I can't stress this enough, but a trustee to trustee transfer or same trustee transfer can be done without the participant receiving the distribution. So what does that mean? Well, you have an account with Fidelity, and you want to open up an account over at Wells Fargo because that's where you bank, and you just want to have everything all together. Instead of going to Fidelity and saying, I want to close my account, give me a check, and I'll go deposit it to Wells Fargo, a trustee to trustee transfer happens when you walk into Fidelity and say, here's my new account information, send it over to Wells Fargo. Now, that is important because I can't tell you how many times I've seen people wait till day 61, 62, day 70, and they go deposit it thinking that they have made a rollover of all their money. Well, unfortunately, they waited too long and the entire amount got taxed. On top of that, I've seen where because they got a check, taxes were required to be withheld. So they took a $100,000 account, they withheld $20,000 in taxes, and that person ran directly over to the bank and deposited their check for $80,000. In this case, they have not rolled over 100% of their account. What they would need to do is make up the difference of that $20,000. So they'd take $80,000 from their other account, deposit it, take $20,000 from a savings account and deposit in that account. And now you just did a 100% rollover and you'd get your $20,000 back when you filed your taxes. If you don't do that, you have a $20,000 taxable distribution. Now you'll get a majority of that $20,000 back, but you're still paying taxes on that $20,000 because you did not roll over the full 100% amount of that account. So converting a traditional IRA to a Roth IRA. So can you convert funds? Yes, you can convert funds from an IRA to a Roth. But keep in mind, when doing this, this is a taxable event. So you don't want to take your entire $400,000 IRA and roll it over into a Roth because you're going to get taxed on $400,000. This is something that can be done strategically, so you're paying minimal taxes on a rollover each year. And we're going to get to the benefits of why you would want to potentially have it in a Roth as opposed to a traditional, other than the whole tax deferred versus tax-free distribution. So now this will come into play for many of you may have heard the term a backdoor Roth. So keep in mind that you can, in any given year, contribute to a traditional IRA and then roll it over to a Roth. Even in a year where you don't qualify to contribute to a traditional IRA and take the deduction. So I'm just going to give you an example. You made $250,000 in wages and you're covered by a plan at work. In that case, you would not be eligible to contribute to a Roth. Well, you can contribute to a Roth or a traditional IRA and get the deduction. But you can put the money into your traditional IRA, not take the deduction, and then the very next day, roll it over into a Roth. This way you got your money into a Roth, even though you technically don't qualify to contribute to a Roth, which you didn't do. You rolled money over to a Roth. So this is what a backdoor Roth is, and is a kind of a roundabout way to get money into a Roth account, even though you may not qualify to contribute to a Roth. So the modified AGI and filing status requirements for converting a traditional IRA to a Roth IRA has been eliminated. This was eliminated several years ago, but it used to be you had to make less than $100,000 to do so. And if done right, these may be able to be done tax-free. Just once again, one of those situations where your deductions are going to be greater than your taxable income for the year. So let's just say this year you didn't need any distributions. You had plenty of money and that you decided to live off this money in the savings account. So you have very minimal. You only had $10,000 in distributions. Yet you're married, filing joint, $24,000 in standard deduction. That means you have $14,000 to play with. You could convert $14,000 of your traditional IRA over to a Roth IRA, and you don't have to pay any taxes on that. Once again, they're very specific situation, may not apply to most, but a situation that is doable. So limits. There is a $6,000 limit to a contribute to an IRA. That is if you are under the age of 50. For most of the people in this class, it's going to be the $7,000 a year limit for the contribution. Now, you must have taxable, looks like, should be 7,000, not 700 there. You must have taxable compensation though, like I said, in order to contribute. You must have earned income. So your limit is the lesser of the $7,000 per person or the amount of earned income you made. So let's say you had a part-time job and you made $3,000 in earnings this year. You can only contribute up to the $3,000. You would not be able to contribute to the $7,000. Now let's talk about a situation where you're still working, but your spouse is not. They're retired. They have no earned income. And you made $50,000 this year. You would still be able to contribute the maximum amount of $7,000 per account for both yourself and your spouse. You both don't need to work. There just needs to be earned income on the tax return. Now, if you're filing separate returns, like a married filing a separate return, then you would both need to work. But if you're filing a joint return, there just needs to be earned income on the tax return, not earned income from both spouses. So the difference between the two, you can contribute at any, you cannot contribute at, they got rid of this, they changed this. You can contribute at any age for an IRA. And so they've done away with that, where you couldn't contribute anymore after, receiving your RMDs. You may be able to deduct the contributions from your IRA, but you cannot deduct contributions from your Roth IRA. Now, we talked about when you're not able to deduct the contributions to your traditional IRA, you have to file that 8606 form. That's what tells the IRS that you have what's called a basis in your IRA account, and that when you take that money out, it should not be taxed. All right, they have to have those 8606s on file. Those need to be filed every year, and they don't necessarily need to be filed with your tax return. They can be filed by themselves. So let's just say 2 years ago you did this, and you're just now realizing, oh shoot, I did not file that form. You can go back and file that form on its own. You don't have to go back and amend your return. And then distributions are taxed at the ordinary income tax rate that you fall in for traditional IRAs, where Roth IRAs, if done right, can be completely tax-free. So can a taxpayer contribute to a traditional IRA if he or she has another retirement plan? So what do I mean by another retirement plan? This means that you are still working and you have a retirement plan through work. It doesn't mean that you participate in that plan. The IRS knows whether or not your employer offers a plan to you or not. Whether or not you participate, there's a little box on the W-2 in box 13 that says retirement plan. If that is checked, the IRS knows that you have limits on your contributions to your traditional IRA account. I'm not going to go into the details of what those are. Just know that it does depend on whether you are covered by a plan at work, whether your spouse is covered by a plan at work, whether you're both covered by a plan at work, or whether nobody is covered by a plan at work. And all that can change. All that changes what the limit is on how much you can make and still be able to deduct your traditional IRA. You can refer to publication 590 for further information on that. It has a whole table of when you can and cannot take that deduction. So a lot of people will ask whether or not they can deduct a donation of their IRA account to a qualified charity. And the answer is yes, you can deduct up to $100,000 of an IRA distribution to a qualified charity. All right. This was a temporary thing that was made part of the permanent part of the tax code. But if you contribute, let's just say the full $100,000, you don't pay taxes on it, but you also don't get take that as a deduction on your Schedule A as a charitable contribution. Or you don't get a double dip like that. And typically you make these qualified charity contributions directly through your plan. And it will show the correct code that it was a qualified charity contribution on the 1099-R.
We have a chat out there.
Oh, wait, there we go. Must the rollover be done in the calendar year, or it's the calendar year? The rollover's got to be done. Because on the rollover, they're going to issue you a 1099, which will be at whatever happened between 1/1 and 12/31. And even if it is a complete non-taxable rollover, let's just say it's a trustee to trustee transfer from a 401k to an IRA, and you roll over 400,000. Do not get scared when you get a 1099-R for $400,000, because it is going to have a code in box 7 saying code G that tells the IRS that this was a direct rollover and that it's a non-taxable event. Okay. And on that note, if you have anything that's very specific to your tax situation, normally I'd have time at the end of the presentation where I'd have you come up, stay at the podium, and you'd be able to ask your questions. But since we're in a Zoom meeting, can't do that. But the very last slide has my phone number and my email. So please feel free to reach out to me, and I'd be more than happy to answer any questions you may have about your very specific personal tax situation. Okay, so moving on. In 2020, with the CARES Act, there was a big thing in there for IRA distributions. So you were able to take up to $100,000 of an IRA distribution and label it as a disaster distribution. And if you're able to, if you labeled it as a disaster distribution, it really was just you telling your brokerage or whoever was giving you the money that yes, it was for that. You are able to either have it all taxed in 2020 or stretch it out evenly over the next 3 years. So for easy round numbers, let's just say you took out $60,000. You can either include it all as $60,000 this year, if it's most tax beneficial, or you can have $20,000, $20,000, $20,000 in 2020, 2021, and 2022. Now, from my understanding, the brokerages will be issuing a 1099 for the full amount of the $60,000. We will just be inputting it that you are delaying the taxes for the remainder of that $40,000 or whatever the number is for the next 2 years. Now, also what they're allowing you to do is repay that distribution over the next 3 years. So let's say you took out $100,000 and next year you decide that you don't want to pay tax on that full $100,000, you have the extra money and you decide to put $50,000 back in. You can do that. You would just need to go back, and if you took the full distribution as taxable in 2020, then you would amend your 2020 taxes. If you decided to spread it out over the 3 years, it needs to be spread out evenly, so you wouldn't be able to change the remaining years by just the remaining balance. You'd have to go back and amend 2020 to split it out evenly amongst the 3 years. But you do have that option of repaying the distribution over the course of the 3 years. So moving on from retirement accounts, we're going to cover assets and selling assets. And this gets a lot of people into a lot of trouble, especially that last one there, rental properties. I think that's, yeah, that rental properties. So what is an asset? When we talk about assets, people talk a lot about capital gains. And actually, before I get into that, someone brought up a question that, so if you did not take a required IRA distribution at all in 2020, you were fine. They suspended that for 2020. So you were not required to take an RMD in 2020. Back to the assets. So these are all types of capital assets, and these are things that are going to generate capital gains or capital losses. Okay, so what is an asset? Your primary home, stocks, bonds, collectibles like a stamp collection. I use that because this actually came up as a discussion, and I think my first or second presentation being done, as well as rental properties. When you sell these, it is a taxable event. And you could, especially things like rental properties and large collections and primary homes, can generate a very large taxable a tax liability. So how does selling an asset affect my taxes? The profit, the key word there, that profit from any asset will be considered income and will increase your overall tax liability. So just because you sell something doesn't mean you pay taxes on the sales price. You can sell something for $1 million, but if you paid $1 million for it, the profit on that is zero. So therefore it is zero. That does not mean you don't need to report it, because something may have been reported to the IRS. And typically when things get reported, some things only get reported, like a sale of a property, like real property, like a real estate, will get reported on a 1099-S, and they only report the sales price, not what you paid for it, what you put into it, and all that. So it's very important that even though you may not have made money on these events, that you have to report these on your taxes. So the profit from any asset will be considered income and will increase your overall tax liability. How does the death of a spouse affect my assets? So keep in mind, this is applies to both the death of a spouse and any inherited property. But when you inherit property, either from a parent, maybe a sibling, or your spouse, you get what's called the stepped up basis. Very important. So let's use some numbers here. You have a house that's valued right now at $500,000. You paid $100,000 for it. So both you and your spouse both have a $50,000 basis in the property. Now, for easy math, we're just going to assume that you haven't put any money into the house or anything. So right now, if you were to sell the house without taking any exclusions into account or anything like that, you would have the potential for paying taxes on $200,000 each. All right, and in profit. So it's the $500,000 minus the $100,000 combined basis. So $400,000, $200,000 each. Now, your spouse passes away, and their basis was 50, but it is currently at their basis that passes to you is the value, the fair market value of the property today. So I know the fair market value is $500,000 because that's what it would sell for. So now your new basis in the property is your original $50,000 basis and your spouse's stepped up basis of $250,000. So you have a basis of $300,000 in the property now, and will only pay taxes on the difference between that and the sales price of $200,000 now. And we're not taking into account any kind of exclusion on that because that's something else. Okay. And this not only comes into play with real estate, but any capital asset. So rental property, stocks, bonds, collectibles, all that stuff. And same thing happens with stepped up basis when you leave properties to heirs. So you have a rental property that's worth $1 million and you've depreciated it down to basically nothing. And I'll get into what all that means in a little bit. And so if you were to sell the property, you'd have $1 million taxable gain, but you pass away and you leave it to your heir and they sell the property for $1 million. Then they would pay zero taxes because they get the stepped up basis of the value today, which is $1 million. Very important. So when I sell an asset, how much do I have to pay taxes on? Well, that's going to depend. All right. If it's a capital asset, it could be 0, 15, or 20%, depending on your filing status, as well as how much money you made. I'm not going to get into that. That can be, you can look that up or ask me later about your individual tax situation. There is a lot that goes into determining how much income will be included from the sale of that asset, though. How much was it sold for? How much did you buy it for? When did you buy it? What type of property is it? And what were the costs to sell that item? So for anybody that's ever owned a home, you know it, you didn't just buy the home, never put a dollar into it, and turn around and sell it at no cost. When you bought the property, you had to pay title and escrow fees. Throughout the years, you've put on a new roof, put in a pool, did some major landscaping, put in an extra bedroom, and redid the kitchen. All that goes into the basis of the property, as well as the 5 or 6% you're selling your real estate, you're giving your real estate agent to sell the property, as well as the title insurance again for the second time, and all the escrow fees. So it's very important that you pay attention and keep records of those, because if you have no records, as far as the IRS is concerned, it didn't happen. All right. Now I know many of you may be thinking, oh my gosh, how am I going to figure out what I didn't keep the closing statement from the property I bought 40 years ago. Unfortunately, obviously that's nothing we can do about that now. But that's why it's very important to always keep these records, because if you need to go back and prove anything, that is going to be your proof. Going back to actually not only, but when you bought it and when you sold it is very important, because if it's more than a year old, then it's a long-term asset, which would fall under a long-term capital gain, which is limited at that 0, 15, or 20%. If it's stock, let's say you bought it at the beginning of the year and you sold it in October, that's going to be a short-term capital gain, which gets treated as ordinary income and is taxed at whatever tax rate your income falls in. So a transaction to be cautious with: day trading. I've seen a lot of people get into trouble with this. You buy and sell, buy and sell, buy and sell, buy and sell. Keep in mind that when you do your taxes, you're going to have to report all those sales. Anytime a stock is sold, it's a taxable event. Now you may be saying, well, I never saw $1 of that money. It just kept getting reinvested and reinvested. Same thing with all the dividends you got. Well, it was still made available to you. It is therefore taxable. So you may have done really well and increased your stock portfolio from $20,000 to $50,000. But if you did that with sales, it's taxable. If you bought stock and just let it sit there and it went from $20,000 to $50,000 and you haven't sold it, then it's not taxable. It doesn't become taxable until you've sold it. Cryptocurrency. So this is, it was a popular belief, especially when people started getting into cryptocurrency, that cryptocurrency was not taxable. It absolutely is. The IRS treats it just like stocks and bonds. Now, and there are a lot of people that are trying to not have to claim the gains on their cryptocurrency, but the IRS is eventually going to find all that information out. They're getting this information from the cryptocurrency brokers and are going to treat them just like stocks, and the penalties for not reporting that are going to be very high. So selling your main home. This one is a lot easier in trying to get it to not be taxable. So you get a big exclusion when it comes to your sale of your main home. If you sell it and you lived in it for 2 out of the last 5 years, and it was your main home 2 out of the last 5 years, you get a $250,000 exclusion if you're single, and $500,000 exclusion if you're married filing joint. That means if you bought it for $600,000, sell it for $1 million, you have a $400,000 profit. Normally that would get taxed, but because it qualifies as selling as your main home, you get to exclude up to $500,000, meaning that $400,000 is not taxable. And this does not apply to assets in a retirement plan. So if you want to buy, sell, and you increase your portfolio, but it's in a self-managed IRA, great. Then nothing's going to happen with that, and it's not going to affect your taxes because it is in a tax-deferred account and won't affect you until you actually take that money out of that account. The big one here that it's not showing on here, but selling of your rental property. This causes a lot of people a lot of grief because a lot of people don't understand what goes on with rental properties and deductions that are taken with rental properties. So when you buy a home, the value of the home is split into two things: the value of the house itself versus the value of the land. Now, I'm going to use a $100,000 property with a 50-50 split. Now, we know that you're probably not going to see that here in California, but just going to use that for easy round numbers. Now, the $50,000 of land does not get depreciated. And you got to become familiar with the term depreciation. The $50,000 of the house does. Now, what is depreciation? Depreciation is for assets that have longer life of more than 1 year. So for example, and I'm just going to really gear this towards rental properties, you patch a roof, that is a repair and is not a long-term asset. You put on a new roof, that is a long-term asset. You fix the kitchen because a couple of doors are falling off, that's a repair. You put in all new cabinets, that is a fixture and is longer life of more than 1 year. That has to be taken a portion of the value of that expense gets taken over the life of that asset. Now, the life of that asset is set by the IRS. For example, a residential rental property is 27 and a half years. Fixtures are 7 years. Things like carpet are 5 years. Okay, so each one has its own lifetime, and a portion of the value. So you put in $1,000 in carpet. It's more complicated than this, but we're just going to, for easy math, you're going to take a portion of that over the next 5 years. So 2020, 2020, 20. So you take a $200 deduction this year. Same thing applies to the house. So going back to that $50,000 in the value of the house, what's going on is you're slowly reducing that $50,000, which is your basis. So if you've had the property for more than 27 and a half years, you have zero basis in the house itself. The only basis you have left is in the land. So when you sell that property, you're paying taxes on the amount of depreciation you took over the years. So let's talk on a much bigger scale. You have a house you bought here in California for $500,000. The house was worth $400,000 itself, with the land being $100,000. You've owned it for 30 years, so you fully depreciated the house. And you turn around and sell it, and the house hasn't gone up in value. You sell it for $500,000. So you really haven't made a gain. But you have tax liability on the $400,000 now of all the depreciation you took over the years. It's called depreciation recapture, and comes as a real surprise for people. Okay. And so you have to be really careful with that. And it's something that people think, oh, well, I just won't take that deduction. I don't really need it. Unfortunately, that is not an option. The IRS says you must legally take every deduction that is made available to you. So even if you don't take the depreciation and don't take advantage of that tax deduction, the IRS will assume you have and just treat it as if you had all along. Now, there's ways to accelerate that depreciation. If that's the case, there's forms you can fill out and whatnot, but just more work. And so you take the deductions as they come to you, but know that if you had a rental property for quite a long time, there could be a very large tax liability coming when you sell it. So discuss, figure out the tax liability, discuss with your tax person. If you have questions, you're more than welcome to come to me, and we can take a look at what that potential tax liability may be when you sell that property. Because I've had several clients who decided not to sell that property because it was just going to be a huge tax hit, and it just wasn't worth it to them. I see a question on what is the max of the primary home exclusion. The max is $250,000 for a single filer, $500,000 for a joint filer. And this deduction has always been around, but they've changed it a little bit in that it used to be a one-time deal. You take it, never get it again. Now you can actually take it every 3 years or every 2 years, after 2 years. So every 3 years, you can actually take it. You just got to meet those two rules of you must have lived in it for 2 years, and you must have owned it as a primary residence for 2 years. So one question someone has asked in the past, and it's, what happens if I can't prove my basis? So for example, the going back to the stamp collection that I talked about years ago, or that I talked about that someone brought up. Like, well, I've been collecting this stamp collection for the last 70 years. I don't have receipts for all this. Well, unfortunately, if the IRS says you don't have receipts, then your basis in it is zero, and you're going to pay taxes on the full amount. And that really goes for anything. You're unable to prove what you paid for it, then you paid nothing for it. All right. So moving on, deductions. So only medical expenses. Once again, let me back up here. These deductions fall on your Schedule A. And a lot of people are not able to take these deductions anymore because of the increased standard deduction. So before going through a lot of these, I'll have clients that will ask me, well, I'm going to go through all my medical expenses and I'm going to gather all my receipts. Well, you got to ask yourself, is it going to be more than 7.5% of your AGI? And on top of that, if I add up that, your mortgage interest, your real estate taxes, and your charitable contributions, is it going to be more than the $24,000? And 9 out of 10 times the answer is no, it's not. So then it's, you know what, don't waste your time going through all your medical expenses because it's not going to be beneficial. Now, if you think it's going to be close, then sometimes it is worth it because the state does have a different standard deduction than the federal. But there's also things that they don't include, like your state taxes paid as a deduction. So it's a case-by-case basis whether or not you go through it. But just keep that in mind, especially that 7.5%. You made $100,000 and your age, so 7.5%, that's $7,500. Did you come up with more expenses than $7,500? Probably not. Then it's not worth going through all those receipts unless you had usually a major medical expense throughout the year. So as mortgage progresses, so the way amortization works, as your mortgage gets older and older, you may be paying the same amount of payment, but you're paying less and less interest. Less and less interest. And keep in mind, the interest is what's deductible on your Schedule A. So you may be paying the same, $2,000, but when you first got that mortgage, $1,950 of it each month was going to interest, only $50 in principal. And as you're getting into the tail end of that mortgage, only $50 goes to interest, and the $1,950 goes to principal. So therefore, you have a much less likely chance of having enough to deduct on your Schedule A. On top of that, going back to the SALT deductions that we talked about, the state and local income tax, especially here in California, you may have property taxes that are fairly high that put you at that $10,000 limit already. And so the state taxes you paid for your pension distribution, all that, don't even matter anymore. And if you've already hit that $10,000 limit. So a lot of people are limited on these deductions. And typically, unless you still have a fairly new mortgage that has a good amount of interest on it, it's probably unlikely you're going to be able to take a itemized deduction anymore. One thing that's changed on the itemized deduction is that they're allowing this year for the CARES Act to take $300 of cash contributions before your Schedule A, so directly on your 1040. So if you gave some cash contributions that you are thinking that you're not able to write off this year, well, $300 of it can be written off directly against your income, directly on the 1040 without having to itemize. Okay, so estate and gift taxes. Most people are probably never going to, it's a very small portion of our population that can actually go over the lifetime estate tax, but it currently sets at $11,580,000. That is per person. So if you file a joint return, that's over $23 million that you'd be able to leave without your estate having to pay any taxes on it. You also get an annual $15,000 gift tax exclusion, which meaning you can give $15,000 per individual. That's not just an annual thing; it's per individual per year. So let's say you have 3 kids and you want to give them each $15,000. You can write them each $15,000 checks and not have to worry about it. But if you are giving a gift more than that, so let's say your kid is buying a home and you're going to gift them the down payment on that. So you're going to give them $200,000. A lot of people have misconceptions on this. That $200,000, you'd be able to exclude the first $15,000, but the other $185,000 taxes, your children will not have to pay taxes on it, but you will. Now, there are ways around that where you can dip into your lifetime estate tax. And so let's just say you gave that extra $185,000, you'd be able to reduce the $11,580,000 by $185,000, but it would require a separate tax return called a gift tax return to let the IRS know that. Okay. Some things you have to worry about: ID theft. It's becoming more and more, especially when it comes to taxes, and especially when you see things like with the CARES Act. So with the CARES Act, more and more people are going to get refundable credits. And so more and more people are probably going to be trying to file false returns. Now, if someone files a false return in your name and in your social security number, then you are going to need to actually mail in a paper copy of your return. So if you get it back and says someone already filed a return in your name, there's still things you can do to take care of that. You would mail in a paper copy, and then there's even identity theft affidavits that you can mail in with the IRS to let them know, and then they can generate an IP PIN for you, identity protection PIN, so that way you wouldn't be able to file without that PIN going forward.
James, actually, there was a chat sent directly to me. This is from Marion. Can you compare giving a contribution to charity from a bank account to giving through an IRA?
Right. So giving a contribution to from your bank account. So you write a check to church for $1,000. You may or may not be able to deduct that, because in order to itemize, or in order to deduct the charitable contribution, you must be able to itemize. And as I mentioned before, many people are not able to itemize. Now this year it's different, and keep in mind it's only for this year, in that you'll be able to take a $300 deduction directly against your income. But we're not talking about that. Just in general, the $1,000 would need to be greater than your standard deduction when you add that together with your mortgage interest, real estate taxes, medical expenses. If it is not more than your standard deduction, then you get no benefit of it. Now, if you give directly from your IRA, instead of that, now let's just say instead of taking a $1,000 contribution from your IRA, you treat it as a charitable, you send it directly to the charity. You do not need to include that $1,000 in income. You also don't get to deduct it, but it's essentially a deduction by not including it. Whereas if you take that $1,000 and then turn around and write a check to charity, you now have to pay taxes on that $1,000, and you may or may not be able to get to include that $1,000 as a deduction. Now, with that in mind, a tax strategy you may take is called bunching donations. So instead of giving, $5,000 in donations every year, let's just say that that's what you were giving. Instead of giving that $5,000 and not being able to get a deduction for it, maybe you give $15,000 every 3 years. And that's enough to push you over the edge of getting that deduction. All right. You're able to give up to 60% of your gross income as a charitable deduction, or take 60% of your AGI as a charitable deduction. So what that means is if your AGI, adjusted gross income, is $100,000, you can take up to a $60,000 deduction in charitable contributions. And if you decide to give more than that $60,000, it'll just roll over to the next year. So retirement planning. I'm going to try to move here. I keep getting a reflection. Let me see if that looks a little better. Okay. So some key ages here. Age 50, you can contribute additional amounts to your IRA or employer plan. That meaning a 401k. Age 59 and a half, you can begin withdrawing money from an IRA or an employer plan without paying an additional 10% tax penalty. Age 65, your standard deduction increases. You may be eligible for the credit for the elderly. It all depends on your total income. Age 72, you must begin to receive a required minimum distribution from your IRA or pension by April 1st of the following year. Now, I didn't talk about RMDs too much because this year in 2020, they were not required, but they are going to be required going forward. And it is extremely important to take your RMD. Now, your RMD will depend on how much your plan is, how much is in your plan and all that. Okay, so talk to your financial institution to see how much you need to take. Now, if you have several different accounts that require an RMD, you don't need to take it all. You don't need to take an RMD out of all three of them. You can just take it out of one, as long as you take the amount out. All right, but it is very important that you take that, because if you don't, the amount that you are going to have to take out, the IRS is going to penalize you 50%. So if you were required to take a $5,000 RMD, the extra tax on that is going to be $2,500. Okay, so it is extremely important that you pay attention to those required RMDs. And so that is the end of my presentation. Here's my name, phone number, and email address should you have any questions.
The question is, do you need to take a QCD before the RMD?
You can treat your RMDs as a QCD.
Yeah, James, also, I may have missed it. Did you go over the new Proposition 19
Oh,
changes?
yeah, you know what? I don't remember seeing that in the slide. I'm not sure what happened. Okay, now Prop 19. So I'm not going to go into all the details of a lot of the stuff. Just know that Prop 19, you can now sell your home if you're over age 55 and carry forward the tax basis to your new home. So why is that important? You bought a home, 30, 40 years ago for $100,000, and you decide to move and you sell it and you buy a new $1 million home. It used to be that you're paying taxes on the new $1 million tax basis. Now you get to carry over that tax basis that has been gradually increased over the years to the new property, even though it is quite a significant step up in value. And but that's all because it does have to do with stuff with wildfires and disaster areas, which I'm not going to get into. Just know that because you are over the age of 55, you do get to carry forward your property tax base over to your new home. Right. And so that doesn't affect the only way it really affects your personal income taxes is that you won't see an increase in the real estate taxes on your Schedule A. Okay, but just something to know if you are buying a property or look at selling your property, and that you will be able to carry over your tax basis from one property to the next. And this is just for real estate. So another question is what happens to your carryover deduction if you can no longer itemize? It'll just keep carrying over until you can for 5 years, and then it just goes away. And keep in mind that carryover only has to do with if you do more than, and let me back up. In 2020, it's actually 100% of your AGI. So if you made $100,000, you can donate $100,000 because of COVID. Normally, under normal circumstances, that would be 60. So you'd have to give a very large amount in order to have that carryover.
James, I wanted to cover a couple more items before we adjourn today. So I'm going to pull up a screen share here. I want to mention a few other classes that are coming up here. It should be on your screen right now. On Tuesday at 3:45 to 5, we have another transitions to retirement class. For this one, you do need to be a member. It's on personal finance and retirement. We have a certified financial planner, Danielle Blunt, and she goes over a wide variety of topics, investments, etc. Next is one of our medical series. These are open to the public. This is Wednesday, the 20th of January, 7 to 9 p.m. This one is Living Pain-Free in Your Golden Years. And then next Saturday for this class, Tier Essentials, 9:30 again, we have financial wellness during tough times. We have a certified financial planner, John Pack. He's presented here many times to us, and he'll talk about how to deal with your financial planning during the COVID world that we're all in right now. And that's pretty much it. So I think we all want to thank James again for coming for the 9th time here. Thank you so much, James.
Thank you for having me.